Hey, good morning, everyone. It's Louisa here, and it's Tuesday morning. I have finished trading for the day. I took 3 trades this morning that I'd like to share with you. Despite the fact that the market was a little bit wicky, the trades were pretty much predictable. Like it was pretty straightforward. So let's start on the 15-minute, and let's just take a look at what happened with Asia and London overnight. So we can see here that Asia ranged, meaning that it had highs and lows. And that's what I personally like to see with Asia overnight, because Asia is engineering liquidity above and below. And that way, when London opens, we're going to either sweep the highs or we're going to sweep the lows. That's the function of Asia. So that's exactly what it did last night. So London moved up overnight and created this high at 3:30. I woke up to take a look at it, but I did not. I nearly took the short, but I decided to wait for the morning. I can't remember why, but anyway, I just did. So this morning, price moved down rather aggressively and peaked at about 8:15. Again, I considered going long with London, but I decided to wait for the New York Open. But down here, price swept both Asia low and London low. It created this nice wick. And if you watched my analysis on Sunday, you know that this area down here is a liquidity void, and price has been working its way through this liquidity void. So that gave me the signal that price was, at least for the morning, going to go higher. So now I'm going to move down to the 5-minute time frame so you can see this a little better. So here we have London has come down, we wicked, we created this order block on the 5-minute, which you can see I have outlined, and we're still in this liquidity void. So from here it was pretty predictable that price would move up, and indeed price did move up. Now, what we can't see on this chart that I have on my hourly chart is we have this area up here. Just put this in here, which is an area where price had wicked on a previous day last week, I think it was. Anyway, so this was an area here that I was watching, but I took my first trade. So price was moving up. And of course, I was trying not to have FOMO. And when price created this first fair value gap, when price retraced into it, that's when I took my first trade. So I'm going to move down to the 1-minute just so you can see this a little better here. Okay, so there were 2 trade opportunities or strategies that you could have used. There was the 5-minute opening range strategy. So here's my 5-minute candle high, and here's my 5-minute candle low. Now, if you were trading using this strategy, price came up, retested, and then on this candle here, you could have gone long, so long as your stop loss was on this candle or this candle. You would have stayed in the trade and you would have traded all the way up. So that was one strategy that we could have taken, but the strategy that I took, I believe, was when price dipped into this fair value gap, I went long for the remainder of the ride up to somewhere up here. And also notice that we have a breakaway gap here. So we have first candle, second candle, and third candle. And this is called a breakaway gap when the third candle closes above the second candle. Breakaway gap. What I'm going to do is put in the description of this video, I'm going to hyperlink ICT's video that he did about 3 or 4 weeks ago on breakaway gaps. And in the video, ICT talks about that a breakaway gap is usually at about 20 to 30% of the total run. So it's at 20 to 30%, meaning it has 60 to 70% longer to run. And probably if you were to measure from the start, maybe down here, this would be the 20-30%, and this would be the end point here. So I'm going to link that in the description for you. So if you haven't had the chance to familiarize yourself with breakaway gaps, you can certainly do so when you have a chance. So let's just let me now place my executions on here so that you can see where I took this trade. Now the first trade was my shortest trade, and I bought 3 at 19.062, and then I sold them at 19.087, and that was a total of 20 points. So price dipped back down and then again ended at this location here, this level here, which is 19.144, which was the level that I was anticipating. Once price reached here, it created this nice rejection wick, and then price created this SIBI, and I also had this inverted fair value gap. And so when price came to the top of this SIBI, or the bottom of the inverted fair value gap, I went short. I sold 3, and my idea or my framework is that price may want to come back down to the order block that was first formed this morning. That was kind of my longer framework. So I sold 3 here. I bought them back here, and that was a total of 49 points. And I think I was in the trade for not more than, it was 30 seconds, because this huge long wick came and took me out of the trade, which was fine. I love when that happens. So I entered here at 10.16, and yeah, 10.17. The trade was complete. I didn't have enough time to move my take profit down, but that's fine. If the market wants to give me a 30-second trade of 49 points, I'll take it. And then my last trade, so price moved down, had this big wick here back at the settlement price, which was yesterday's close, wicked back up and came back into this beautiful SIBI. Now, here we have another breakaway gap. Okay, so we have a breakaway gap right here. So we have candle 1, 2, and 3. This is the third candle, closes below the second candle. That's what gives us the breakaway gap. So when we have a breakaway gap, price continues to move down. And then at some point, not immediately, but at some point, it retraces back into the SIBI because it'll want to fill this imbalance. And that's when I went short. So I sold 3, and then I bought them back here, which is the area that this wick retraced back, snapped back quickly. So I didn't want to stay in past here. Now, the other thing that I took a look at, I used my fib this morning. I just want to give you, again, some sense. So those are the 3. So 20 points, 49 points, and 38 points gave me a total of 107 points. And let's just turn that off because it's distracting. And I took my fib this morning, and I took it from the beginning of the move up right to the top of this candle here, and we take a look at the OTE, optimal trade entry. Optimal trade entry is a logical place that price may want to return to, and that is between 62 and 79%. So if we just drop this OTE here on our chart, OTE, there we go, and you can see that price came right to the 70%. Now it's returned to the SIBI. It's gone a little bit higher. I'm not sure what it's going to do from here on in, but that's not my worry because I took my 100 points out of the market today and I'm done for the day. So I just wanted to share these 3 trades with you in my view for the type of trading that I do. Price was very predictable. I had a little bit of luck with the second trade, being under 30 seconds. You don't always get that, but that's fine. But again, I'm going to link in the description the ICT's link to breakaway gaps. If you haven't studied them or you're unfamiliar with them, do yourself a favor. They are fantastic if you're scalping. They're fantastic if you just want to take sort of shorter, predictable trades. And I have found them to be very, very, very helpful. So, hope you guys have a terrific day. Please like, share, and subscribe. And peace out. I'll talk to you next time. Bye for now.